Conventional loans versus FHA loans. What's the difference and why do you need to know as a home buyer? You're going to get thrown tons of names and acronyms as you're out there searching for a home and a home loan. And knowing the difference between a conventional loan and an FHA loan is going to be something you need to know in order to get the best loan for you. Now, you can default to a great loan officer that's going to educate you through this process, like me, or I'm going to educate you right now and tell you all the ins and outs of doing conventional financing versus FHA or Federal Housing Administration mortgages. So, let's jump in. Hi, my name is Brooks Kelly, and I've been a lender for over 17 years. I've helped over 2,000 families achieve the dream of home ownership, and I help hundreds of them do it every single year. My favorite is the first-time home buyer because we get to educate you throughout the entire process. So let's jump in and see what we're talking about today. So here's a brief overview of home loans. First of all, conventional loans, which are 80% of the mortgages that are done in the marketplace today. These loans are not government-backed, but they are regulated by Fannie Mae and Freddie Mac. These are the two entities that make up the rules around conventional financing, and they're all very similar between a Fannie or a Freddie loan, but they have different nuances that, as a homeowner, you really don't need to know. It's up to your loan officer to pick the right one and the right rules that work for you. Now, typical rules around a conventional loan is you can get a conventional loan with just 3% down. Now, there's some programs where you have to be a first-time home buyer to do a 3% down conventional loan. And then there's affordable products like Home Ready and Home Possible where you don't have to be a first-time home buyer. You just have to make less than 80% of the area median income. Now, after you've purchased your first home and you're out of that category, your minimum down payment now is 5% down. You can get 5% down on as many conventional loans as you want as long as you occupy those homes for at least 12 months. So you can buy one today with 5% down, and then a year from now, you can move out, rent that property, and if you qualify, buy another one with 5% down. So there's no limitation on that. Now, if you don't put 20% down, you're going to be subject to private mortgage insurance. Now, what is that? Well, it covers the mortgage company in case you default. So if you don't make your mortgage payment and they have to foreclose on the home for you, that insurance is going to cover the difference between that 80% of you putting 20% down and whatever you finance. So if you put 5% down, it's going to cover that 15% difference, so the mortgage company is not at risk. This was developed over the years in competition with FHA. So coming out of World War II, there was only conventional financing, and they created the FHA loan, backed by the Federal Housing Administration. This created a 3% down loan that gave first-time home buyers and buyers without the 20% to put down the ability to purchase a home backed by the federal government. The reason it had to be backed by the federal government is nobody was loaning at such a high loan-to-value ratio. So the government backed this with mortgage insurance. And on FHA loans, you pay mortgage insurance both upfront and monthly. And over time, the rules and regulations have changed, but you can get into an FHA loan with just 3.5% down today. FHA mortgage insurance premium up front is 1.75% of the loan amount. The good news is for this is it's added back into the loan and not charged to you at the closing table. So you're not having to bring that additional money to closing. It's just added back to your mortgage and you pay on it over time. The different costs of FHA mortgage insurance are changing and change over the years. And right now it's a very affordable 0.55% of the loan amount divided by 12. So just think on a $250,000 home, you're paying about $100 to $110 a month for this mortgage insurance. Now, the difference between conventional and FHA when it comes to cost of interest rate and mortgage insurance is where you see the big difference. On FHA, typically, it doesn't matter what your credit score is. You get the same interest rate and the same mortgage insurance cost. Now, different lenders will have overlays or risk adjustments for lower credit scores, and once you get below 660 or 640, you'll start to see minor adjustments to the rate. And FHA goes all the way down below 580, in a lot of cases down to 500 credit scores, and the lower that credit score gets, the higher the interest rate is. but it's never going to be outlandish or crazy. It's just a risk adjustment in order to offer you that loan program, essentially. Now, the mortgage insurance factor never changes with FHA. So you're always going to pay that 1.75% upfront and 0.55% every single month. On conventional, when you measure these two against each other, it's a very different thing. Conventional is extremely credit score driven. So the best interest rate with a conventional loan is 780. And then below that, every 20 points, you're going to see adjustments to your rate at 760, 740, 700, and on down. You're also going to see more expensive mortgage insurance the lower the credit score. Because remember, I said this is private mortgage insurance, not backed by the federal government. So private mortgage insurance is scored based on a risk factor. So it looks at your debt to income ratio, which is your gross income divided by your monthly debts, your credit score, and your loan to value ratio. So what your down payment is. The more money you put down, the less riskier it is, the cheaper it is. So if you're a 620 credit score and a 45% debt to income ratio, and you're only putting 3 or 5% down, you're going to see mortgage insurance really expensive, like probably 2% of the loan amount, 4 times as much as FHA. So as a lender, I look at these items when we're reviewing your loan to see, okay, at what breaking point does it make more sense for you to go FHA over conventional? Now, I get the question all the time, what's the benefit of going conventional over FHA? Well, the mortgage insurance is cancelable over time on a conventional loan. On FHA, it's not, unless you put a certain amount of money down, which in this case, we're talking about minimal down loans. So that's not even part of the discussion. So if you can get that mortgage insurance canceled, then it might make sense. But what might make more sense is to do an FHA loan, be in that loan for a few years, your credit score gets better and your equity position gets better. And when you go to refinance it, and hopefully interest rates have dropped a little by then, when you go to refinance that loan, you're able to refinance from the FHA into the conventional loan. Or vice versa. Say you bought a home, your credit was really good, and you need to refinance and it makes sense. You might refinance from a conventional into an FHA loan. There's no restriction on you going back and forth. Now let's talk underwriting. Now, conventional loans are more stringent when it comes to approval and underwriting. They have more stringent debt to income ratios that will allow, and the underwriting engine is just a little more picky when it comes to looking at borrowers and all the factors of their credit. You can approve conventional loans up to 49.99%, but in a lot of cases when it gets over a certain threshold with a certain credit score, you're going to see approvability not go through as often. On FHA, it seems to be a little more flat, meaning it doesn't necessarily matter where you lie as long as your debt to income ratio is below 47% on the front end, which means just your housing ratio, and under 57% on the back end, which is all of your debt. So it allows for higher debt to income ratios and a lot more liberal standards when it comes to underwriting. Now, those standards are more liberal based on those ratios, but the underwriting overall is a lot more black and white than conventional. So on FHA, it just is or it isn't in most cases. On conventional, there's a lot of grayer areas, so you can possibly approve for something on conventional that may not fly on FHA. Again, it's always up to having a great loan officer look at your file before you get into this situation. It's great that you're educating yourself and understanding the nuances and the differences in the loan so you can have a great conversation, but you always need a professional that's going to compare and contrast the two to make sure you get what you're looking for. Now let's talk property standards really quick because they're different. Conventional loans look at the property rating being a C4 or better, C3, C2, which means the condition rating of 4 or better. Conventional will allow you to approve your loan with things that are outstanding sometimes, like exposed flooring or some wiring that's sticking out, or maybe a deck or a patio isn't of the best standards, but it's still usable. On FHA, they're going to look at health and safety regulations to make sure that your home is habitable when you move in. So they look for peeling paint, warped and rotting wood, exposed wood touching a structure, all the appliances working, flooring in all rooms, the bathrooms being in working order. They're making sure that this home is habitable and livable for you. On conventional, there's a lot of things that can go by that FHA won't allow. Now, don't let that deter you from an FHA loan. These are general livability standards, and not anything that typically stops a transaction from going through unless the house really isn't someplace that you would be wanting to live. There's also different kinds of FHA loans. You have the FHA 203B, which is a normal everyday FHA mortgage. You have an FHA 203K, which is a renovation loan, which you can use, renovate some of the property as you move in. Or you have Title I, which is the ability to finance manufactured homes. I'm not saying that you can't do manufactured home on conventional too, because you can. It's just FHA has a different title for it, which is Title I. So this was a huge topic through the end of COVID and even into today, is when you're in a competitive situation, a lot of the listing agents will look at the conventional loan before the FHA loan. And while that's founded in some cases, it's not always the best case scenario. Many buyers that are well qualified go FHA. It's not just a first-time homebuyer loan. It's not just for people with bad credit. It's a situational thing. How much money do you have to put down? What does your credit look like? What's your debt to income ratio look like? What income is countable? There's a lot of factors that go into choosing FHA over conventional, but there could be market factors that may push you to do a conventional loan, and that's when it's overly competitive and the listing agent says, we're only accepting conventional offers, or all the other offers are conventional. If you modify your offer to conventional, then we'll consider it. Now, I don't know if that's the best way to go about it, but it does allow for certain things. And one thing especially is the appraisal waiver situation. On FHA, there's the FHA amendatory clause. It's also on VA loans too, but it's saying that the home will appraise for at least the purchase price or the buyer has the right to cancel. And so that exposes some sellers to possibilities if the home doesn't appraise. Whereas on conventional, there's an appraisal waiver form that says, we don't care what the home appraises for, or the home can appraise for $10,000 more, or any different combination of how they want to set that up. But it allows for the appraisal to not come in at the purchase price and still give the seller full control and not let the buyers back out. The FHA amendatory clause absolutely gives the buyers the right to terminate. And so some listing agents will back away from that if they're in a competing conventional and FHA offer situation. So you're going to want to keep that in mind as you go to put offers in, just depending on what the market's like at that time. Now, in conclusion, I hope you got a lot of great information from this. There's so much more that goes around this. The FHA handbook is over 2,000 pages long, and so are each of the conventional ones. So there's so many nuances and differences to the guidelines that you can't just simply make a decision based on this video to say conventional or FHA is the best way to go. It's different for every home buyer. It's different for every situation. So it's really dependent on your situation and what your goals are for monthly payment and your cash out of pocket. Also, of course, we're looking at the factors of your qualification. What's your credit score? What's your debt to income ratio? What's your income like? How can we count your income? And I say that because there's different ways to calculate commission and bonus income based on the loan program that you're going into. Again, there's a lot here. It's great to evaluate. It's great to educate. Ultimately, talk to a professional and they will help you navigate to the best loan program for you. I hope you got some great information. Please follow along. We've got some great videos coming your way. Have a good one. Talk to you soon.